Many traders feel stuck in a cycle of losses, questioning why they can't seem to break free. They meticulously follow every rule, analyze every chart, and yet their accounts seem to slowly bleed out, caught in a death by 1,000 cuts. It's a frustrating, demoralizing loop that makes even the most determined individuals wonder if they were simply not cut out for this world. They see others celebrating massive wins and can't help but ask themselves, what am I doing wrong? Why can't I break through this invisible barrier? The answer, paradoxically, isn't found in a more complex indicator or hidden chart pattern. It's found in embracing the one thing most people are conditioned to avoid at all costs: losing. The path to consistent profitability is paved not with the absence of losses, but with the mastery of them. It's about learning a skill that feels counterintuitive, but is the cornerstone of every successful trading career. Marty Schwartz, a legendary trader who turned an initial stake of $40,000 into a staggering $20 million, once said, "I'm a good loser. I lose small and fast so I can win big and long." This single statement encapsulates a profound truth that eludes the vast majority of market participants. Schwartz, known for his relentless work ethic and almost superhuman ability to read the market's pulse, didn't attribute his success to an infallible crystal ball or a strategy that never failed. Instead, he prided himself on his efficiency at being wrong. He understood that in the chaotic arena of financial markets, predicting the future with perfect accuracy is an impossible task. The real game isn't about being right all the time. It's about managing the inevitable moments when you are wrong. His genius was not in dodging every punch the market threw at him, but in mastering the art of slipping those punches, taking only glancing blows that allowed him to stay in the fight long enough to land his own devastating knockout. The real secret, isn't avoiding losses, but knowing how to take them quickly before they grow out of control. Think of your trading capital as the lifeblood of your career. Every trade you take is a calculated risk, but a losing trade left unattended is like an open wound that continues to bleed. It's a small, manageable loss, is a scratch that stings for a moment, but you can patch it up and move on, your overall health and strength intact. However, when that small loss is allowed to fester, fueled by hope and the refusal to admit a mistake, it can morph into a catastrophic hemorrhage that threatens your very survival in the market. The true professional doesn't see a small loss as a failure. They see it as a business expense, a necessary cost of gathering information. The market has just told them, "Not this time," and they listen. They pay the small tuition fee for the lesson, close the position, and immediately free up their capital and mental energy to focus on the next, more promising opportunity. This is the fundamental discipline that separates the amateurs from the masters. Common mistake among new traders is believing they've found a perfect strategy, only to blow up their account because they never learned how to manage losses. This is the siren song of the Holy Grail system. A novice trader might backtest a strategy and find it has an 80% or even 90% win rate. They become mesmerized by the illusion of near certainty, convinced they've cracked the code to the markets. They dive in with overconfidence, often risking too much capital on a single trade because, in their mind, the odds are overwhelmingly in their favor. The first few trades might even be winners, reinforcing this dangerous belief. But then, the inevitable losing trade arrives. Instead of accepting it as a statistical certainty, they are paralyzed. It contradicts their belief in the perfect system. It must be a fluke, they tell themselves. The market will turn around. They hold on, watching in horror as the small red number on their screen grows larger and larger, eating away at their profits and then digging deep into their initial capital. By the time they are forced to capitulate, either by a margin call or their own emotional breaking point, the damage is done. A single, unmanaged loss has wiped out a dozen previous wins and shattered their confidence. They failed not because their strategy was flawed, but because they had no plan for failure. Most traders do the opposite of what works. They hold on to losing trades, hoping for a reversal, and cut winners too early, afraid profits will disappear. This deeply ingrained psychological flaw is the arch nemesis of profitability. When a trade goes against them, the pain of realizing a loss is so acute that they engage in wishful thinking. The trade becomes a lottery ticket, and they pray for their number to be called. This hope is a cognitive bias, an emotional anchor that prevents rational decision-making. Conversely, when a trade moves in their favor, a different emotion takes over: fear. They fear that the profit, which feels so good in the moment, will evaporate. The anxiety of watching a winning position retrace, even slightly, becomes unbearable. So, they snatch the small profit off the table, feeling a momentary sense of relief. In doing so, they have created a disastrous mathematical equation for their trading account. Their losses are large and uncontrolled, while their wins are small and capped. It is a formula guaranteed to lead to a slow and painful portfolio death, a self-inflicted financial wound born from a fundamental misunderstanding of risk and reward. Short's edge was accepting losses without hesitation, cutting them fast so he could protect his capital and wait for the real opportunities. He treated his trading desk not as a casino, but as the command center of a business. Every decision was rooted in capital preservation. He knew that the money in his account was his inventory, his ammunition. Without it, he was out of the game. When a trade idea was invalidated by the market's price action, he didn't argue or bargain. He executed his exit plan with the cold, detached precision of a surgeon. There was no ego involved, no emotional attachment to being right. The only thing that mattered was protecting his ability to trade another day. This discipline gave him an immense psychological advantage. While other traders were emotionally tormented by their losing positions, Schwartz was already on the sidelines, his mind clear and his capital ready. He could patiently scan the horizon for the next big wave, the A+ setup where the odds were heavily stacked in his favor. He wasn't afraid to take 10 small paper-cut losses in a row, because he knew that the 11th trade could be the home run that paid for all the small losses and then some. Legendary traders like Paul Tudor Jones and Jesse Livermore all emphasized survival over perfection. Protect your money first, profits come second. Paul Tudor Jones, one of the most successful macro traders of all time, famously has a sign above his desk that reads, "Losers, average losers." It's a stark, daily reminder to never add to a losing position, to never throw good money after bad. He lives by the mantra of playing great defense. Isn't focused on hitting home runs on every single swing. He is obsessed with not striking out. Jesse Livermore, the enigmatic figure from the early 20th century, chronicled in Reminiscences of a Stock Operator, learned this lesson the hard way, going broke multiple times before mastering his craft. He eventually concluded that the primary goal was not to make money, but to avoid losing it. This defensive mindset is the bedrock of longevity in trading. It's the understanding that the market will always offer more opportunities, but only if you have the capital left to take them. Profits are a byproduct of excellent risk management, not the other way around. Professionals accept multiple small losses while waiting patiently for a high probability setup. When the big trend comes, they let profits run. Imagine a professional sniper. They might lie in wait for hours or even days for the perfect shot. They don't take pat shots at every target that moves. They are disciplined, patient, and focused on a single objective, waiting for the moment when all conditions align perfectly to guarantee the highest probability of success. A professional trader operates with the same mentality. They can sit on their hands for days, watching the market chop back and forth, refusing to get drawn into low-quality, random noise. They are conserving their mental and financial capital. During this time, they might test the waters with a few small, exploratory positions. If these trades don't work out immediately, they cut them without a second thought. These are just probes, information gathering missions with a predefined minimal cost. Then, the moment they've been waiting for arrives. A major catalyst hits the market, a key level breaks, and a powerful trend begins to emerge. This is their signal. They commit their capital with conviction, and, most importantly, they ride the trend. They don't get scared out by the first minor pullback. They trust their analysis and let the winning trade mature, maximizing its potential and allowing one single, well-managed winner to vastly outweigh a string of minor, well-managed losses. You, Dan, need to be right most of the time. You just need your wins to be bigger than your losses. This is the simple, beautiful mathematics of asymmetric returns that governs all successful speculation. Let's say you have a strategy that is only correct 40% of the time. To a novice, this sounds like a losing strategy. But what if for every $1 you risk, your average winning trade makes you $3, while your average losing trade costs you only $1? Over a series of 10 trades, you would have 4 winners and 6 losers. The 6 losses would cost you $6 total. But the 4 winners would make you $12, $3 by 4. Your net profit would be $6. You were wrong more often than you were right, yet you made money. This is the power of positive expectancy. The world's greatest traders are not market wizards with a higher win rate than everyone else. They are master risk managers who have structured their trading so that their profits on winning trades dwarf their losses on losing ones. They have internalized the fact that the frequency of being right is irrelevant compared to the magnitude of being right. This mindset extends beyond trading. Being willing to accept small failures in life is often the path to long-term success. Every successful entrepreneur, artist, or scientist has a history littered with small-scale failures. The startup that didn't get funding, the experiment that yielded no results, the manuscript that was rejected by dozens of publishers. These are not signs of incompetence. They are the necessary steps in the process of innovation and growth. Each failure is a data point, a lesson learned, a course correction that guides them closer to their ultimate goal. Just like the trader who cuts a loss quickly, they are failing fast to conserve their resources, their time, money, and motivation for the idea that will eventually work. The fear of failure is what paralyzes most people, keeping them in jobs they dislike or preventing them from pursuing their passions. By embracing small, manageable setbacks as an integral part of the journey, you free yourself to take calculated risks, to explore, and to ultimately achieve something far greater than you would have if you had only played it safe.